Good afternoon, everybody. Again, my name is Len Lonzi, Managing Director for the Preccelerator program here in Santa Monica. We're a program of the law firm Stubbs, Alderton, and Marklees. Today, I'm excited to introduce to you both Isaiah and Evan. Isaiah is with Carta, and Evan Wright is with Checkmate Equity. And they're going to make a presentation today on Equity 101 and cap table management. So the way we'll do this is they're going to present their material, and I think we'll hold questions to the end, and we'll have plenty of time for that. So sit back, relax, enjoy the presentation. I'll let them do their own self-introductions, and I'll turn it over to Evan.
Perfect, Len. Thank you so much for having us. I know Isaiah and I are really excited to be able to come in and present today. To talk about Carta as well as Checkmate Equity, and specifically just go over kind of some Equity 101 and some great ways to think about your cap table as you continue to scale your companies. So I'm gonna go ahead and share my screen. So you should be able to see my screen here.
Before we get started, Evan, if everybody could mute themselves until question and answers, that would be helpful.
All right. Perfect. Well, just I'm going to do a quick background about myself. So I've been working in the venture equity space for about 5 years now. Before joining Checkmate Equity, I actually spent 4 years at Carta, where I started off leading the implementations team in Salt Lake. And then I was relocated to Seattle to do portfolio modeling for venture funds, where I would model out all of their cap tables for every single holding of their company. I would also do financial forecasting for them. So then the companies could see their fully diluted ownership percentages, as well as understanding how the companies should be performing moving forward. Isaiah?
Hi, everyone. I'm Isaiah Deporto Plick. I've been in the venture space for about the same time as Evan, a little over 5 years. I actually started my career as a startup and venture capital attorney at some law firms, first in Southern California and then in Seattle, before joining AngelList and doing a host of things at an early stage startup, including product operations, really just a little bit of everything, and then made my way into business development at a number of places and ended up here at Carta, where I primarily manage relationships with our law firm partners, including Stubbs Alderton and a host of different banks and other service providers in the ecosystem.
So before we get started, we just wanted to do a quick word from our lawyers. So this communication is on behalf of eShares Inc., doing business as Carta Inc. This communication is not to be construed as legal, financial, or tax advice, and is for informational purposes only. This communication is not intended to be as a recommendation, offer, or solicitation for the purchase or sale of any security. Although this presentation may provide information concerning potential legal issues, it is not a substitute for legal advice, or any opinions or conclusions provided in this presentation shall not be ascribed to Carta. Carta does not assume any liability or reliance on the information provided herein. Now, Isaiah, I'm going to let you tackle the agenda here.
Yeah, so first we'll go on over equity basics, and Evan and I will tag team here, and we're going to talk about the type of stock you get as founders, as employees, advisors, as well as investors. Talk about exercise prices, what fair market value is, what 409A is. I'm sure many of you have heard the term. It gets thrown around a lot. Talk about vesting schedules and the differences there. Then we'll talk about exercising. It really is a tax consideration for employees, as well as a financial cash consideration. Talk about our decision making there. And then finally, we'll talk about selling and liquidity when it comes to private market, mostly private market companies, and touch a little bit on when companies do go public via IPO. Equity basics. So what is equity? Equity is really any stock or security. Sometimes, especially as a founder, they're called restricted stock awards or just restricted stock. It's really just any security that represents an ownership interest on the LLC side. It could be a profit unit, membership unit, stuff like that. And for equity, and this goes back to Carta's mission in that we're trying to create ownership and grow the ownership economy. And it's really about owning a piece of the company that you work for, so that one, you can share in the success and you're more bought into the success of the company because you're an owner. I mean, we've all heard the stories of Uber employees, Facebook employees, Google employees, making tons of money when the companies went public. And that's what the dream is for a lot of people that work for startups. So the benefits, you can see here on this slide that, salaries are generally pretty stagnant in their growth, right? You generally, you'll get a 3 to 5% increase every year. Unfortunately, that's not keeping up with inflation this year, but it's equity that really is exponential in its how it grows, right? It doesn't grow in a linear fashion. The value typically, especially in a high growth startup, grows exponentially over time. Brandy, I see your question. We're going to get exactly to that later in this presentation. We have an entire slide on the different types of equity. Before I get to that, I want to talk real quick about cap tables. And really this is what Carta's core business is. A cap table essentially just lists out the ownership of a company. Could be a startup, it could be any business that has multiple owners. About 10 to 15 years ago, a lot of cap tables were managed in Excel. We can all guess why, that's never a great idea for a long-term strategy when you have 100 plus stakeholders and things get easily deleted in Excel. Additionally, one other thing that Carta did back 15 years ago, a lot of startups would mail stock certificates to their investors, to their employees. Anyone who owned stock would have a paper stock certificate. Oftentimes they'd get lost. And so when you have either an IPO or an M&A event, you have to mail those back. It's a whole process to do a loss certificate affidavit. And so what Carta did is basically electronize stock certificates and make it so that you don't have to put your paper stock certificate in a file cabinet somewhere. So yeah, an equity grant agreement. So this is, when you're joining a startup, one of the pieces of paper that you're going to sign or now electronically sign is an equity grant agreement whereby you're going to get equity as part of your role as an employee. It's going to tell you whether it's incentive stock option, which are granted typically to employees only, or non-qualified stock option, which is in some case granted to employees, but also can be granted to advisors and other service providers that work for a startup that aren't employees. We'll give you your vesting terms, your start date, your grant date as well. And so you'll need to accept your grant agreement. That's one of the big things. Carta's made this easy. It's really easy to go in and accept. And it doesn't force you into anything. It's free. It gives you the choice, especially when it comes to options. You don't have to purchase your options, and we'll talk about that a little bit later. So just some terms related to equity. So first we have common stock. Common stock is typically granted is the stock that employees eventually hold when their options are purchased and they're purchasing common stock. There are also typically what is granted to founders. Founders will sometimes get what's called founder preferred stock, and that may be preferred stock, or it might be common stock. It gets a little confusing. It just depends on the terms of the stock. Preferred stock, on the other hand, is typically granted to investors, whether you're selling in a venture capital round or you're doing an equity financing to angel investors. There's fewer equity rounds that go to angel investors, but they do happen. Exercising is the practice of, once your options are vested, exercising is the practice of purchasing those options, and then those options become common stock in the company. FMV, also called fair market value, and a 409A. That's 409A of the tax code, the Internal Revenue Service Tax Code, IRS. What that means is all options have to be granted at the fair market value at their fair market value. So that's just for common stock. And 409A essentially says, if you get an audit done, or a valuation rather done by a independent third party provider, you have safe harbor for the next year, meaning the IRS essentially believes that you're granting these options at their fair market value. Strike price is when you go to exercise, your strike price is the price that you're exercising your options at. So in a very early stage company, it may be 10 cents, it may be 5 cents. That means you're paying 5 cents for each option and converting that to common stock. Vesting may be time-based, typically time-based, could also be milestone-based. You see this in healthcare and life sciences companies. Where they're either waiting for a patent or FDA approval, and then you have some shares that vest. Early exercising is an option to actually exercise before you vest. There's some tax advantages to doing so. Not every company offers early exercising, but it allows you to basically save on some taxes. Post-termination exercise period. This comes into play whether it's a company termination that's not for cause or a employee-led termination. Basically, the most common window of time is 90 days after you're terminated or end your employment. You have 90 days to exercise any vested options. Settlements refer specifically to restricted stock units. And so restricted stock units are typically what you see in later stage companies. And the reason for that is because the exercise price or strike price of those options become too large. It becomes too high for employees to actually pay cash to exercise. And so companies instead choose to issue restricted stock units. And when they settle, when they're vested, the RSUs settle, meaning that they're basically turned into common stock. They convert into common stock. You get shares for that. Evan, did you want to cover this slide?
Yeah. So, there are two classes of stock. There's going to be common stock and preferred stock. So where do warrants fall? You'll typically see warrants be a preferred stock right there. So common, it's going to be just the most basic, rare form of stock, and it's typically issued to employees. So for an employee stock option pool, that's going to be pulling from the fully authorized common shares. They're usually paid out after holders and preferred stock in liquidity events, and it's also set for the FMV. So when you're going out and raising a round, just going back to the liquidity events as well as it's paid out after, a lot of the preferred stock will actually be stacked on top of each other. So as you continue to do more and more rounds, the liquidation preferences will always have, not always, but most common, the most recent preferred share class that was created be the highest liquidity. So those most recent investors will be paid out first, and then the employees will be paid out last in case there's a merger and acquisition. So for preferred stock, once again, it's typically issued when raising capital, typically issued to early employees or founders and high-level executives and investors. And then holders of the preferred stock will be paid back first, and the preferred stock is valued at a higher price because the offer of additional rights and protections. So part of the preferred stock being valued at a higher price, you'll hear terms such as original issue price which is the price of the preferred stock on date of issuances, as well as conversion price. So those are going to be two terms there, where if there is acquisition or an IPO, where it is already determined what that preferred stock will convert to. So yeah.
I'll jump in real quick to answer the question on warrants. I think warrants come up in a couple of different situations. One is typically in the venture debt situation where you take take loans from a bank that's offering venture debt, and that warrants essentially they also have a strike price that allows the holders of your venture debt to buy typically common stock, sometimes it's preferred stock, but to buy stock in your company. The other scenario where they come up is in an investment rounds. Sometimes companies and investors will negotiate the addition of warrants in addition to preferred equity. And basically that's an investor saying, hey, I really believe in your company. I want to own more in order to get my money now. I want some warrants as well to buy preferred stock or common. Sometimes it's common stock. I've seen it go both ways. And then in a future event. And then just add to the next question, preferred stockholders would be paid back first. You mean in the event of a default? So in the event of a default, yes. So default, any downside scenario, basically. So even in an M&A event where the returns aren't large enough to pay back preferred stockholders their return, which is typically 1x of what they've invested. So the same amount. So if they've invested $50,000, if the M&A event isn't enough to give them $50,000 back, then they get paid before everyone else. Typically in a positive M&A transaction or in a IPO event, especially in an IPO event, the preferred stockholders are actually going to convert their shares into common stock at a 1-to-1 ratio, because the common stock is going to be paid out at a higher rate than the preferred stock.
Do we still want to hold off? Do we want to try to hold off questions for the end? I know we're getting some good ones here at the moment.
Why don't you go to the next slide and then I'll.
Okay.
Yeah. All right. So real quick, talk about types of stocks and the difference between ISOs, NSOs, and restricted stock option or restricted stock units. So ISOs are they're tax advantaged. That's why they're ISOs, restricted to employees. They are only taxed typically when you sell your shares, unless you're subject to what's called the alternative minimum tax, which we'll talk about in the beginning or in a second, AMT. The difference in NSOs, non-qualified stock options, is those are taxed both at exercise and when you sell the shares. You'll need to exercise them at the fair market value. So that's not the fair market value that you were granted at. It'll be the fair market value. Actually, it is the fair market value that you were granted at, and how the IRS calculates your tax ownership or your tax obligation is the difference between your exercise, your strike price, and the fair market value at the time that you are exercising. So if that's been 2 years or 4 years, if you're at a company that's still doing well, that exercise price has likely gone, or that fair market value has likely gone up. And then, yeah, exactly. To Eli's point. Yeah. Which is typically the case unless typically, so NSOs are only taxed, the fair market value is greater at the strike price than at time of exercise. Exactly, that's typically the case. Because typically you would see either a repricing done, or an employee would likely hold off on exercising if the strike price is lower, or if the fair market value is lower than the strike price. And then, okay, when we get to the vesting, so vesting is, we talked about this early, it's the right to actually own your equity. So again, there's time-based vesting, which the most common schedule we see is monthly over 4 years, with the exception of the first year. There's a first year cliff, and after that cliff, that first year cliff is 25, you vest 25% of your shares. And then after you hit that cliff, you will vest in monthly tranches over the remaining 36 months. The other is milestone vesting, where, typically, again, biotech companies with FDA, seeking FDA approval or patents, that's where you have that. And then settlement, we talked about this earlier. This is where you get the shares for your RSUs. And then here's an example of your vesting schedule. It will be outlined in your grant agreements. So again, exercising. So when we're talking about exercising, this only refers to options. This is your option to purchase your shares, because an option really is an option to purchase shares. And then your exercise price, strike price, we covered this, the fixed price you pay for one share of the company's common stock. And so if your exercise price is $1 and you own 1,000 shares, you're paying $1,000 to exercise. And so the fair market value, just real quick, is typically as you grow in later stage situations, it will be done by a 409A valuation. In the earliest days of the company, and it's a 409A valuation, and then your board of directors approves your 409A valuation, basically saying, yes, we agree, that's the fair market value. In the earliest days of the company, the board of directors were actually set the fair market value and not get a 409A valuation. But at some point, you grow, when you start to have real revenue, it's time to bring the third-party experts in to make sure that as you grow, your fair market value is as accurate as it can possibly be. Evan, did you want to cover this section?
Yeah. So part of the documentation that you accept, when you are receiving the electronic certificates, is going to be the termination periods for when you end up leaving the company. So whether it's company initiated, employee initiated, or initiation with cause. So for employee and company initiation, the industry standard is a 90-day window in which, once you have left the company and are no longer employed, you actually have about 3 months in order to be able to exercise. However, if there is a termination with cause, which is typically more of a legal termination, such as a fraud or theft, you're given 0 days in order to exercise. But these are all some things that a lot of employees will ask about. Say, hey, it's been a great 4 years. I'm fully vested. I haven't exercised any, and I'm ready to leave. And this information is in the fine print and is readily available with the documentation that they signed electronically when they first joined the company. So purchasing shares in a private company has a risk. And not every company does succeed. So, when you are considering exercising, here's a pretty good framework that you can pass along to your employees. So, they want to understand how much they're looking to spend between the exercise process as well as the taxes. So as Isaiah was able to reference earlier, you're going to be taxed on that delta between the strike price and the current fair market value. You want to consider things such as, are there any life events that I'll need this cash for? And for the tax process, how important is the tax efficiency? Do you understand the tax implications of AMT? And then also understanding the risk. So where do you see the company going? Are you comfortable with the idea that you may not be able to sell for 3, 5, or maybe even 10 years? And also, are you comfortable with your asset concentration? So what a lot of what early stage employees will have is maybe 90% of their net worth is actually tied up in a very successful startup. But there, it can be some concerns with all of that allocation into one investment, which is the company. So we're going to get into selling a little bit and just how you can kind of think about that. And I'm going to let Isaiah tackle this one.
Yeah, before we get to that, I'm going to jump in and answer some of these questions on 409A while it's top of mind. So in terms of states, so the 409A is a code, is a statute in the IRS code. So it's a federal statute. States may have, and I am not a tax accountant. Taxes are not my area of specialty. So states may have their own laws, tax laws with regard to equity and how employees have to treat them. It's always best to check with either your attorneys or your accountants, as they will know best. The trigger for 409A in practice is working with your lawyer, and they typically say, hey, it's because they've seen a number of clients, right? And they've said, they'll know, hey, at this stage of the company, a bunch of my clients do get 409As. This is where I typically recommend it. I would say that the standard trigger is when you've had a material change in the company, like you sign a multi-million-dollar contract, stuff like those. These are just examples, top of mind examples. You land a large customer where that value, you're essentially materially changing the value of the company, thereby changing the value of the common stock. And then Eli, to your question, you can't set the fair market value of the common stock at the value of the financing. And the reason for that is when we're talking about 409A and we're talking about fair market value, that applies to common stock only. Preferred stock, and we will touch on this in this presentation as well. Preferred stock has its own rights and privileges that are negotiated between investors and the company. And so they have their own set of rights. They have their own price and their own valuation. That's actually a negotiation between investors and the leadership of the company. And so 409A and the fair market value does not apply to preferred stock. It only applies to common stock.
Yeah. And also to just comment on Sue's question. So what's the trigger for the 409A? As Isaiah said, a material event, whether it's a new round of financing or dramatic change in revenue. Also, the IRS, in order to be compliant, every 12 months, you must receive a new 409A evaluation. Carta does the most of them in the US. So, they are a provider there. And then Eli, in terms of, your question, can't the board just set it to the financing? So there's going to be a factor of discount of lack of marketability, which I believe is DLOM for short, which is part of the equation. Just because, you're not able to necessarily go out and sell those common shares right away. So that also has to be a part of the equation, which is going to be something that is talked about pretty regularly when you are requesting a 409A evaluation from a provider. Hope that helps.
Yeah, there's no threshold in raising capital to trigger the 409A. I think raising capital typically does trigger a material change, whether it's $250,000 or $5 $500,000, I think it triggers it. Again, it's important to talk to your attorneys when thinking about, should I get a 409A or not? And Brandy, yes, that's DeLong, that's right. The discounted the lack of liquidity, and that like you can't sell your common stock. And in fact, most private companies and startups have restrictions on common stockholders and their ability to sell shares, preferred stock as well. It's a very restricted type of stock in terms of selling it to anyone. And then what to think about before selling. So in the event that your company has set up a secondary transaction, which does allow you to sell either to an investor or sell back to the company, there are ways to set up liquidity for private companies, for startups. Carta has a platform that does this, Carta Liquidity, that we facilitate these transactions, often called tender offers, or just known as a secondary transaction. So if you're an employee and you're thinking about selling, your company has offered you the right to sell, there's a couple considerations. Do you need the cash now? Are your options in the money, i.e. worth more than your strike price? Does your company have any restrictions on selling? A lot of companies, when they do set up tender offers or secondary transactions, they'll let you sell, let's say 25% of your vested shares, maybe a little bit more. Not always. You're typically not allowed to sell all of them, but again, it's on a company by company basis. Do you think your shares will be worth more in the future? And is it worth holding on to your shares for a later liquidity event like an IPO or an M&A transaction? What are the tax implications and the tax burdens? And are you prepared to save money for your tax obligations? And then again, do you think, this is going to be a one-time liquidity event? Do you think you'll have the opportunity to sell in the future? If you're leaving the company, do you think, or plan to leave the company in the next 6 months? Do you think, the company will open up future liquidity opportunities to ex-employees? Those are all considerations. So again, here are some of the ways to sell your shares. If you're a public company, we all know it's easy to get on, Robinhood or SoFi or any broker, to any bank, right, and sell shares. You can buy and sell shares while we're talking, right? With private companies, there's 3 ways. Again, secondary sales, tender offers, an acquisition. If a company buys, especially if they're offering cash, sometimes they offer their own shares in exchange for your shares, or the final one, an IPO. And 2022 has been a slow IPO market, but I think 2023 we will see some of these later stage companies gear up and actually go public. So how sales are taxed. So first we have the alternative minimum tax, which is affectionately known as AMT. And this is the minimum amount that you have to pay to the IRS. When you do your taxes, your accountant will calculate your ordinary income and your AMT, and then you have to pay whichever one has the bigger tax obligation. There's also capital gains tax. These are the taxes on the profits you're going to make from an investment. If you have a qualifying disposition, which there's a lot of different, the tax code has a lot of different caveats to capital gains tax, where you can actually, not have to pay any capital gains tax at all, just depending on your situation. You get preferential tax treatment. Early exercising. We talked about this a little bit earlier. This is exercising before you vest, and it minimizes your tax burden. So basically what you're doing when you're early exercising is telling the IRS, and let me be clear on this too real quick. Not every company offers early exercising. Some companies choose to not offer early exercising. It's just not something they want to put in their grant documents. But when you do have that option, and you believe in the company, you think the company's going to grow, you think your shares are going to be worth something in the future, you can essentially tell the IRS that you want to pay income tax now instead of when you vest. And basically, if you exercise as soon as you get the grant, there's no spread. There's likely no spread, unless, you wait a day and the company signs a massive contract the day later. But typically there's no spread between your strike price and the fair market value of the stock. So there's zero gain for you to recognize. That means your tax obligation you're minimizing it. When it comes to 83Bs though, you have to file within 30 days of this early exercising. I'll liken it to any founder stock, for founders that have gotten founder stock. Similar there, you have to file your 83B within 30 days of receiving that founder stock. It's a requirement for early exercising. Carter's actually built a way to do this where you electronically sign and we take care of the mailing to the IRS for you. QSBS, I'll touch on this really quickly. Qualified small business stock. This came out as part of the Jobs Act. And what this essentially says is for really early stage companies, and I believe the gross assets test is sub 50 million, and it has to be a C Corp. Basically, investors who invest in QSBS stock, they get and they hold it for 5 years themselves. They get the opportunity to exclude up to 100% of capital gains tax from federal tax. The 5-year holding period is a personal requirement. So if an investor doesn't meet that 5-year holding period, it's not QSBS eligible. Qualified industry for these is typically any startup. I couldn't say for sure on cannabis, just given where we're at currently, just with legislation coming down the pipeline, but most startups do qualify for this. And then 80% of the assets used in business operations, meaning you can't be an investment company where your assets are used to invest in other businesses. Evan, do you want to cover this?
Yeah, of course. So trying to put it all together, you know what, you're going to be able to accept your equity grant or have your employees accept their equity grant and stock options or RSUs. You're going to allow your stock options to vest, whether it's milestone vesting or time-based, which is the most common. You want to make sure you understand the strike price and the FNV. So whether it's yourself or employees who are asking you questions, you're able to give them those detailed responses. The exercise and purchase of the stock options, you may have to pay taxes and make sure that this is set up. So whether it's, sending in the 83B to the IRS for early exercise, or just making sure you understand the AMT tax as well. And then also for selling your shares in a liquidity event, whether it's an IPO, merger and acquisition, or tender offer. And then once again, paying your taxes. And then finally, the last step, profiting, which is why a lot of early stage employees are working for startups. So how much is the equity actually worth? Well, we're actually going to go through and do a few hypotheticals here that Isaiah is going to be able to lead. So we're actually going to use Zoom's IPO as an example here.
So let's look at Anna. So she joined Zoom in April 2013. She gets a grant. 1 year later, so after that cliff, she gets 1,000 stock options. As soon as they vest, she chooses to exercise her stock options at $1 per share. So she effectively pays $1,000 for those shares. At the time that she's exercising, the fair market value of those shares is $10,000. So she has a gain there. Zoom goes public in April 2019 at $36 per share. So at $36 per share, her shares are now worth $36,000. So there's a spread of $35,000 between what she paid and what the IPO price was. In October 2022, she decides to sell all of her shares, and she ends up with $80,000. And so there's a gain of $79,000 on that original grant that she paid $1,000 to exercise. And so this is, this is the ideal situation, right? This is that big windfall. Obviously, we're talking small numbers, but you could see if you had 10,000 shares, if you had 20,000 shares, how this multiplies really at an incredible rate. And then we'll talk about in the money M&A. So Adobe acquired Figma, largest tech acquisition ever, I believe. And this is a different scenario because it's an M&A scenario. I believe Adobe paid cash here. Sometimes in M&A transactions, companies pay in stock rather than in cash. And Brandy, to your question, yes, likely Anna paid taxes on that 79K because it depends if she would have got an ISO. This doesn't, she got ISOs. Yes, I just saw that. So she doesn't pay taxes when she exercises. She pays taxes when she ultimately sells, I believe, with ISOs. Somebody correct me if I got that wrong, but I'm pretty sure that's the case. And so she pays taxes when she sells the stock. And so Ryan joins Figma in June 2021. He's issued 2,000 RSUs over 4 years. He's vested 500 of those in July 2022. And so these are RSUs, right? So he's not exercising. He doesn't have to pay for his RSUs. As soon as that time vest happens, what happens is the RSU settle into shares and he owns them outright. Again, but he doesn't, even though on his first vesting date, the fair market value of those shares were $25,000, he's not actually going to get any money for those shares until a liquidity event, but he will have tax obligations on vesting dates when the settlement happens. And then once the M&A transaction, Ryan will realize that $50,000 gain, and he'll get, assuming Adobe paid cash in the transaction, he will get cash for his shares. So below the money M&A. So these are situations where, again, we were talking about earlier, downside scenarios where the company is not, getting back, let's say it's current, whatever its valuation, it's the acquirer is not paying that. And so it's not a great situation for employees and everyone involved. But let's say, this is a situation where Todd joins Mars in June 2020. He has 1,000 shares a year later, his stock options vest. He decides to exercise at his strike price of $2 per share. So he pays $2,000. The FMB at the time of his exercise is $10,000, but Google only pays a year later when Google acquires the company. It's not in the money, and so they only pay the price they pay results in a cash amount of $1,000 to Todd. So he ultimately lost $1,000 on his original exercise. And so this is a situation where, it happens in the startup world where you do make that personal decision to exercise your shares. And ultimately the outcome isn't, a positive financial one. I still think there's a lot to learn from any startup adventure, but financially it's not a positive outcome for him. This is an example of a secondary sale, typically later stage companies. So Mary joins Venus Inc. in June 2020. She's getting ISOs in this case. A year later in 2021, thousands of her ISOs vest, 1,000 options. She decides to exercise. So she pays $2, 2,000 total for all of her options. And then Venus decides to allow eligible employees to sell common stock to a buyer in a tender offer. And eligible employees is really up to the company. They could put a 10-year restriction on it. Again, they could say, you can only sell a percentage of your shares, stuff like that. That's really a company decision. And so Mary says, I'm going to sell 750 of my shares. And I'm going to hold on to the remaining because I think the company will have another secondary, or they'll have a positive M&A transaction or go public. And so at the time she exercises, the fair market value of the company is $10,000. Again, no cash here, but she sells 750 of her shares for 11,250. So she has an ultimate realized gain of $9,000, 9,250. And she still has 250 of her shares remaining. So she still gets to participate in any future upside. So how can Carta help, especially when it comes to secondary transactions? So one of the things we offer, one of our newest offerings, is Carta Tax Advisory. And one of the things we've been hearing, and we went out to the market and did some survey data, is that about 70% of employees expect their companies to provide them with, tax advice about their equity, right? Or overview sessions, right? And for a lot of legal and tax liability reasons, companies, can't really do this, right? It's always, go talk to an accountant. Well, most early stage companies just can't afford an accountant, to go have one-on-one sessions. So Carta's really filling this void in that we work with companies to provide Carta Tax Advisory as an employee benefit. So part of this is we will provide webinars sort of like this that give employees overview of equity, overview of what ISO is, NSOs, the different tax scenarios involved, what an RSU is, exercising that type of thing and the considerations. In addition, employees also have access to an unlimited number of one-on-one sessions with Carta tax advisors that are licensed CPAs that can give employees very specific advice to their specific tax situation when it comes to their equity. So this is just going into a little bit more. Like if you have a liquidity event, this is where this tax service really comes into play, because it will help employees figure out what their tax obligations are going to be if they choose to partake in a secondary sale or tender offer, and what they need to withhold for taxes to the IRS and any state entities. So this is one of the things in terms of how we help employees. The Carta Tax Advisors actually prepare a spreadsheet and provide employees with scenario planning and talk them through and actually show them the numbers and give them the numbers, send them the numbers to show them, what the different risks are involved around, paying cash now, how much you have to come out of pocket with exercising or selling your shares and stuff like that. Again, this is, just another selling point, and that, I think the biggest thing here is the personalized one-on-one support, so that companies really, they don't have to worry about, hey, having a person on staff, to tell employees, how to manage their tax situations or get into that legal liability. They don't have to worry about, lawyers or accountants being too expensive. They have these one-on-one support. And again, these situations are, or these scenarios and this webinar, not the webinars, but the one-on-one support is unlimited for employees.
Now, where does Checkmate Equity kind of come into play here in terms of your relationship with Carta, the cap table management software? So for about us, we're actually former Carta employees, where we saw that Carta created an incredible software, as well as a very strong service as well from the tax side, which you're able to utilize to make sure your cap table is a single source of truth. However, as I continued to work on the implementations and portfolio modeling side, we noticed that a lot of founders didn't necessarily actually want to go in and manage the cap table themselves. Typically, the founders are the most knowledgeable people in the business, and their time is incredibly valuable. So they would always reach out to us, actually asking to update the cap table, which is where Checkmate Equity was born. So, just at a glance, we're all equity experts and Carta experts. We do a flat rate pricing, and you actually have a dedicated equity administrator assigned to your account. So you can build that personal relationship and that rapport with us. And all Preccelerator companies are able to get a 15% discount as well in terms of utilizing our services. And we have 3 services here. So we have a premier onboarding where you're able to provide us with the documents, and then we're able to make sure you're onboarded onto the Carta platform. The equity administration is an ongoing service. So as you continue to grow and scale your team, instead of yourself going in and actually issuing out the option grants, the ISOs or NSOs or RSUs or even warrants, you'd be able to utilize our specific skill sets there in order to make sure that the cap table is up to date, and then also doing cap table audits. So for some individuals who might not have updated their cap table in a few months or maybe in a year and don't necessarily know where they stand, we're able to actually come in and create a report for you and make sure everything's taken care of. So the specifics of the Premier onboarding, it's a white glove service where you all would be able to just upload the documents, into the Carta platform. We would then go through the document one by one. So we'd be requesting, the articles of incorporation, any safe note agreements or convertible debt agreements, common stock purchase agreements, and then also documentation surrounding the ESOP. We have a deal with Carta and Carta Launch specifically, where if it's 1 to 10 stakeholders, we can get you onto Carta Launch for only $500. And then if it's 11 to 25, it's $750 for the onboarding process. For the ongoing equity administration, a lot of the value adds that we're able to bring in is the drafting the new issuances, the certificates, equity awards, the warrants, safes, convertible notes. We also like to do a proactive educational approach to your new hires, as well as new individuals who are joining your cap table, where we like to send out a heads up email template. So then those individuals are aware and educated about equity, where we are able to give them, some information about, okay, what is a strike price? What is a fair market value? What is a vesting schedule? So then, you're not receiving those questions later down the road, where we're able to come in, assist them, and then give you time back, as well as make sure that those new individuals don't have any questions about their equity. We also assist with exercises, cancellations, transfers, and then we also do, monthly reporting. So you and your board are able to see how the cap table has changed, and then also, stakeholder termination and modeling and execution. So then they're able to see, okay, how many shares have I vested? How many shares have I purchased? And how many shares are left to be purchased, as well as how many shares are going back into the pool. And then for the cap table audit, we're able to make sure that your cap table is verified and all data points and supporting documents, do line up. If we do see any discrepancies in the reporting process, we're actually able to give you the discrepancies as well as the recommendation to the remedies. So whether that's be, updating a few things such as, vesting start dates, or just making sure people are being marked as terminated. These are all things that we feel very comfortable with. And Isaiah, I know you working at Fenwick, you had some tough times doing some cap table audits when the company's are in the later stage. So making sure your cap table is set up for success in the early stages of the company's life cycle is incredibly important in order to save you a fair amount of legal costs down the road. As well as just to be able to provide the cap table readily to investors, if you are going to be receiving new capital. And then here are some resources here that we want to make sure that are readily available, and we can pass these links on after this call to make sure everybody has it. And then I know we also have a fair amount of time for some questions. I think we've been able to answer most of them here during the presentation, but I have seen a few more come in while Isaiah and I have been talking here recently. And I think, Brandy, you recently had one. Carta is a platform for the docs, but Checkmate actually updates them. That is correct. So if you were going to be hiring, a new cohort of individuals, you'd be able to pass us along those new hire agreements. We would then go through the new hire agreements, go into the Carta platform and update that. So I don't know if that's something you're currently doing or you're having your law firm do. But for us, we'd be able to take that off your plate or your law firm's plate and, make sure that when they have those questions about accepting all the information and those equity grants, that we can tackle those for you instead of your law firm or yourself. And then if we missed any question during the presentation, we'd love to have people be able to repost them now. And then I can go back and, pull up the slides to those specific questions if we missed any.
Questions, Evan and Isaiah, I think you've hit them all as they came up, so I didn't see anything outstanding.
Okay.
So good job on that. Does anybody else have any questions that you'd like to ask out loud? We can accommodate that also. You'd have to unmute yourself.
Hi, I was raising my hand, but I'm Brandy, and I have a quick question. I know that there has been talk about a holding period when something goes, when a company goes for an IPO, that you have to hold your shares for a little bit before you can sell them. Was that just chatter, or is that something that's real?
So that is definitely real. It's what's called a lockup period. And it's typically 6 months, although I will say there's changes in the venture market. I've started to see 3 months, or you've started to see the lockup period go away. And that's typically true for both employees and often investors too, unless the investors negotiate an ability to sell earlier. But the lockup period is typically and standard for the last very long time, 180 days.
Okay, thank you.
There's a new question in chat.
Do startup advisors always get shares, and what kind of shares do advisors typically get? So I would say no, they don't always get shares, and I think it depends, right? There's a lot of it. A lot of people have a lot of opinions in this space, and a lot of people have a lot of advice. So to the extent you have mentors, or people, and you can get advice without giving up equity in your company, do it. Because at the end of the day, your equity in your company, especially as a founder, is the most important thing you have. That being said, if you have advisors that are materially adding a ton of value to the business, or they've brought you in a major company or a customer contract, then by all means, if you want to offer them equity, go ahead. Typically what we've seen, and this is data from Carta, is about 0.25%. And I would definitely attach vesting schedules to that. Typically the what they receive are non-qualified stock options out of the plan, because those are the ones you can grant to not employees. Sometimes they'll be given other awards, but I think NSOs are typically the most common.
There's also a follow-up question there, Isaiah. How do we create and track dual class shares? Example, Facebook, Uber, where a founder has 20x votes per share.
Oh, you want
Go
me
ahead.
to?
Go ahead.
Okay. Yeah. And Isaiah, you were actually a lawyer, so you might know more about this, but I think I know the answer to this one. So Christopher, for that one, when you're refiling your articles of incorporation, I'm assuming you haven't done this, you haven't had those created yet. You'd be able to go in and create a new share class, whether it's a new common share class. So you can have a common A and a common B. And with those common B, which is going to be the new share class you'd be creating, you'd be able to actually designate where it has, a 20-to-1 voting preference over the other share class. You would also make sure that that is passed by the board, as well as that's written in the bylaws. But that would be where you would start to have that. And that's how it can be done from a legal paperwork perspective. Isaiah, I'm gonna let you, did I miss anything?
Yeah, that's exactly right. Definitely, when you get to a dual class structure, that's definitely an individual startup by startup base. Like on a basis, you definitely want to take in mind how investors are going to feel about it. Is it, a super hot company where investors like Facebook or Uber, where people were clamoring, especially Google, people were clamoring to get in and didn't mind. And then, it's just it's a really personal decision, but from a legal paperwork standpoint, it's all done in your certificate of incorporation, and your lawyers will be familiar with how to set up those structures.
There's another question in chat.
Yeah, Brandy, to answer your question, Checkmate does. So part of our equity administration service is actually pro forma cap table modeling. So when you do sign up for the annual service, if you were to be raising a round of capital or taking on additional investors, what you'd be able to do is actually send us over the terms for that new round of capital. We would then be able to go into the Carta platform, model out that pro forma cap table for you, and then be able to send that over to you. And with that pro forma cap table, we would make sure to highlight the new fully diluted ownership percentages, so you can see how investors are being diluted while you take on new investors and new capital. This is something that Carta has allowed us to do, as we're their preferred partner.
Yeah, and on the Carta end, we've built a scenario modeling tool for founders to help model that out. We also recently released for lawyers, which lawyers often build out what's called pro forma in venture financings. We actually built a software tool to help lawyers generate pro formas.
Oh, Chris, example, if Anna is selling her 90K profit, is the IRS selection 83B, does she still need to pay tax on that gain?
Yeah, because she's realizing the gain. Even though they were ISOs, I'm pretty sure ISOs, you don't pay on the exercise, you pay on the gain. That's where she's gonna need to pay on the gain of realizing that actual profit.
For your comments and questions today. I want to thank Evan and Isaiah today. This is a new partnership with us, the Preccelerator. We're happy to have Checkmate Equity on board. And we've always had a relationship with Carta, so this cements that a little stronger. And thank you all for participating today. And as we come to close for 2022, I wish everybody a safe and happy holiday season. And we'll look forward to seeing you all in 2023. Happy New Year, everybody.
Thanks, everyone, and happy holidays and happy New Year.
Happy seasons. Bye.